So it's Chart Summit. I brought a lot of charts. I love what Matthew Verdal said, that fundamentals drive the markets, but technical analysis allows us to take advantage of it, which at the end of the day is really all we care about, right? We're not trying to drive anything. We're trying to take advantage of what's being driven. So I thought that was very well said. I think Tyler likes that one too, right? We'll use that. So, all right, let's get right into it. So we came into the year, you know, markets getting slaughtered in the fourth quarter. Fortunately, we were on the right side of that. And dollar was ripping, right? US dollar. So we were approaching key levels. If you guys want, email me. I'll send you those charts from back in the fourth quarter. The dollar was approaching key levels, breaking the uptrend line from the early 2018. This is the US dollar index. So this is the trade-weighted index. We'll get to it in a second. But just to give you a little bit more background, the idea was, all right, so if the dollar's going to break this trend line, hit a key retracement from that entire rally in 2018, and it's just going to rip right through those highs, then something bad is probably happening to stocks. And the US dollar just ripping is probably being used as some sort of safe haven, right? Some sort of flight to safety because equities are getting slaughtered, right? Similar to what we saw in 2008, right? Stocks got killed, dollar ripped. As soon as the dollar peaked in March of 2009, got killed, stocks ripped, right? So the thesis was, all right, if dollar keeps ripping, there's a big problem in the stock market. So flip that thesis upside down, and it's like, well, if the dollar is not ripping and is actually selling off, then stocks are probably doing well in that environment, right? So that was the thesis coming into the year, and so far that's playing out. The US dollar index traditionally, particularly the one I'm talking about, 60% of that is euro, right? Then you got some yen, some pound, a little CAD, Aussie. This is the trade-weighted dollar, which has over 20 currencies and is much broader based. So the thesis has been and continues to be, if this dollar is selling off, which I mean is I can make a pretty solid argument, technically speaking, that yes, indeed, the US dollar will sell off. We have a nice bearish momentum divergence, double top, forming resistance. You know, we can keep going. For you guys interested, you know, I'm not going to get up here and do this whole education thing, but if you're interested on how we look at Fibonacci, how we look at momentum, go to allstarcharts.com/education, and I lay it all out there. So excuse my voice. We're drinking a lot last night. Skiing, I'm yelling because Brian Shannon and Todd Gordon don't wait for me in the Jerry, and they're flying down. I'm like, guys, where'd you go? And I'm like stuck in the middle of the freaking woods. I made it. I was never known for my speed. All right, US dollar, lower, I think. So, kind of common sense, who stands to benefit from that weaker dollar? Emerging markets, right? So here, emerging markets relative to the S&P 500. Hold on. Boom. So we've got support again in 2016. We broke through that last year and now getting back above it. If we're above those former lows on a relative basis, got to be overweight EM, right? If emerging markets are doing well, what type of stocks are probably doing well too? The first one that comes to my mind is Freeport-McMoRan, right? It's the, mining, metals, all that stuff. So it just so happens that we got a beautiful rally in Freeport off the 2016 lows, peaked at the end of 2017, early 18, got crushed, and literally stopped at the 61.8% retracement of that entire move. Maybe a coincidence. I would argue no. Nice key support, and we're ripping. One of the best trades of the year. I still believe that the path of least resistance is higher, particularly if emerging markets are outperforming the S&P 500. This guy should keep doing well, and we retest those highs. So think about the types of stocks that will also do well in that environment. Probably the gold bugs are finally going to have their day after a decade of being losers, right? So they're going to have their day. It goes in cycles, right? I was just in Vancouver. Of course, they're bullish. So it wasn't just Freeport-McMoRan on an absolute basis, but on a relative basis as well. Here's a 61.8% retracement of that entire move. Bullish momentum divergence. So a lot going on in Freeport. And we do a lot of intra-market analysis. So stuff in the currency market is suggesting this. Then we look at the stock market, it's suggesting the same thing, right? And here we are. So the way I learned it from the Louise Yamadas of the world, shout out Louise, we want to buy smiley faces, not frowny faces, right? We want to buy these guys. The bigger the base, the higher in space, right? That's how she taught me. So, look how frustrated these gold bugs have been. Just, you could have been in anything during this period other than gold and done well. So that frustration, that built up get me out of this thing, is what drives markets higher, right? Supply and demand. I would argue supply and demand drives markets, Matthew. So if gold's going to do well, gold's idiotic little brother silver is probably going to do even better, right? It's the higher beta, more volatile. We look at that, the 2012 and 2016 lows in the US 10-year yield, right? And us as technicians, look at that double bottom like in reverence. Are we going to be looking at this double bottom in silver at Chart Summit 2025 or whatever and be like, oh my God, that was the most epic double bottom ever? I think there's a good chance. So we'll go into the trade in a minute, but I kind of want to show you quickly before we start getting into global market, kind of what's on my mind. So here's silver for above 1490. That's all that key support down there. I think we got to be long. I think we can get up towards 16.5, 17 for now. And then ultimately, why not get back into the 20s? It's a serious move. If you guys want a copy of all of the slides, email me, info@allstarcharts.com, and the password, brilliantly, is Chart Summit. See what I did there? So info@allstarcharts.com. All right, so that's kind of what's on my mind, when I'm going to sleep at night, when I'm thinking about earmuffs, Morgan, right? So that's where my head is at. So now where my analysis really begins is in global markets, right? Even if you don't trade global markets and you're just trading US stocks, there's so much information from global markets that it would be irresponsible to ignore it. Adam's laughing, shaking his head. He tells me when I do my monthly conference calls, he just sits back, right? Pour yourself a nice drink and just let me go after it. So you're not seeing anything new here. Here's the London FTSE 100, guys. Probably in the Mount Rushmore of most important indexes in the world. It's kind of a big deal. And the way I see it from a risk appetite versus risk aversion perspective, if the London FTSE 100 is breaking out of a 2-decade base to new all-time highs, man, it's tough to be bearish, right? From any sort of intermediate to structural perspective. So I'm looking at the 99 highs, I'm looking at the 07 highs, 15 highs. If we're above that, let's just call it 7,000 on the London FTSE. If we're above that, how can we be bearish? Got to be buying stocks. Here's a short-term look. You'll see a lot of this, I'm noticing around the world, where you're getting this mean reversion. So you got stocks, indexes, ETFs, sectors, near flat 200-day moving averages. So what does that mean? It means it's a mess, right? But it doesn't mean that we can't go higher within the context of a mess. So we want to be watching our stocks, our consolidations breaking out of consolidations, or are they breaking down from consolidations? I'm noticing more breakouts than breakdowns. Would you guys agree? It's a market of stocks, not a stock market. So I was like, well, the pound sucks. So if you price it in dollars, it's a different story. All right, well, let's price it in dollars. So here's London price in US dollars. Again, the path of least resistance still seems higher to me. So price in whatever currency you want. Here's Europe, hot mess. Just a messy mess. Right? That's a technical term. Messy mess. 1 test, 2 tests, 3 tests, 4 tests. I think the 5th one doesn't, and Europe finally breaks out. Here's a closer look. Similar London, approaching that 200-day moving average. It's messy. It's messy with the path of least resistance still higher, but messy nonetheless. Here's the Euro Stock 600, kind of broader Europe look. And then speaking of the Mount Rushmore of the most important indexes in the world, Germany, God bless their hearts, for, Deutsche Bank. Deutsche Bank's crashing every day in the fourth quarter, and they come out with their list of like the top 10, reasons to be worried about 2019. They don't include their stock crashing as one of those reasons. I thought that was cute how they did that. Again, mean reverting, right? Path of least resistance still higher. I think we're going to 12,000 in the German DAX. It's another 600 points. It's not nothing. France. When you ask me, JC, why do you think that Euro Stock 600 is going to break out, right? Is this magic indicator? It's like, no, well, I look at all the countries in Europe, and I'm like, wow, check, 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 and it looks like a lot of them are breaking out, so the index should follow as well. Here's your downturn line, resistance, resistance, resistance. Here's your failed breakdown, your bear trap, your hook, call it what you want. Squeezes on. If France is squeezing higher, Europe's probably doing pretty well, right? What's France? Second most important in Europe after Germany? Yeah, right? Certainly not Spain. So here's Belgium. Nobody looks at Belgium, but I gotta tell you from the bottom of my heart, for years and years, and you guys who have been following me for a while know this, man, what a great indicator Belgium is. Belgium's breaking down, guess what? The other ones are probably following. Belgium's breaking out, guess what? The other ones are probably following. You wanna talk about a great indicator? The Bell 20. Half of you probably didn't even know it existed. Excellent indicator. Speaking of Spain, one of the worst places on earth in terms of risk, appetite versus aversion. Obviously, my family's from Spain, for the record. We call them pigs, for God's sakes. So if money's flowing into Spain or Italy or Portugal, it's not evidence of risk aversion, in my opinion, right? Money's being put to work because it wants to be aggressive, right? Here's a similar little hook, little bear trap, as we saw in France. I think it squeezes on. And here's the ETF, for you ETF traders out there. The EWP, breaking the downtrend line, something Belgium hasn't done but seems about to do. Squeezes on, path of least resistance is higher, in my opinion. And then here's Italy. So there's a lot going on in this chart. I want you to focus on this bottom and this bottom. They look exactly the same. And I think this time goes the exact same way as this one. And we go retest those former highs. If Italy's ripping, stocks are probably doing pretty well, right? Now let's talk about a few indexes that don't get mentioned too often. Finland. Nice multi-year base, breaking out. Denmark, multi-year base. Looks like a breakout is coming. Sweden, rally, consolidation. Looks like a breakout to new all-time highs is coming. So if we're getting multi-year breakouts in these indexes, that's probably an environment that we want to be buying stocks, right? So we want to be watching Finland, Denmark, Sweden. Here's a closer look. Doing all the right things. Hungary. Rip your face off rally, sideways consolidation, and I think it resolves higher with the others, right? So all of these indexes. Frickin' Poland. We got a Polak here. Any other Polish? And there you go. Poland, again, not exactly a safe haven. Breaking down trend lines, path of least resistance, I think is higher. Turkey, again, not exactly a safe haven. Consolidation, breakout, successful retest, bullish momentum divergence, I think path of least resistance is higher. Now let's get into some, more commodity-based, more natural resource-based countries. Canada near a flat 200-day moving average, but breaking out, still higher. Same thing with Australia. Above those key 2015 highs, right? I think this is a big deal. I think we go retest those highs. Thank you to Optima for these beautiful charts, by the way. So here's a good one. We're probably not going a lot higher without Japan, right? So those are the 2015 highs in Japan. 2015 highs in Germany, 2015 highs in France. There were a lot of important peaks, particularly in Europe, in 2015. So if Japan is above those 2015 highs, we have to be buying stocks. The stock market, in my opinion, is not going to get absolutely destroyed if Nikkei is above the 2015 highs. Bad things will happen, or could happen, if Nikkei is below those 2015 highs. This is probably one of the most important indicators I'm watching in the world today. Hong Kong, Mount Rushmore of the most important indexes in the world, no question. We failed at the former highs, and the 261.8% extension of that crash. Path of least resistance higher. I think we retest those highs, ultimately break out. If Hong Kong's breaking out like that, it's probably an environment we want to be buying stocks. Here what I did was I equally weighted the Brics. Brazil, Russia, India, China, South Korea, and South Africa, equally weighted, breaking out to new all-time highs. Here's emerging markets, EEM, which is not equally weighted, far from it. Long downtrend, beautiful breakout, successful retest. Path of least resistance is higher. I think the squeeze is on in emerging markets, which we talked about the relative strength earlier. We talked about what Freeport-McMoRan is doing, right? I think all of that is the same story. The lower dollar, right? So we do a lot of intermarket analysis, not because I'm trading the Turkish lira, right? We're looking at this as information. Squeeze is on, I think. So let me show you something interesting. So stocks are getting slaughtered in December. We're pumped, you know. Me and Bruno are like, yeah, you know. One for the good guys, right? It's nice to get lucky sometimes. But with new lows in all these major indexes, not just in the US, but globally, emerging markets, which one's this one, 2018, emerging markets are putting in a higher low. That's a hell of a divergence right there. What's happened other times we've seen a similar divergence? Well, in 2016 low, new lows in the S&P 500 in February, higher lows in EM, market rip for the next 2 years. 2009 low, new lows in March in the S&P 500 and Dow, higher low in emerging markets, epic market bottom, right? We ripped for years. 2004, some of you are old enough to have been around back then. Lower low in the S&P 500. This is me graduating college right here when emerging markets were putting in that higher low. And what happened? Stocks ripped for another 3 years. So we just saw the same divergence now. So when you're arguing, well, JC, a little late now to buy emerging markets. Well, I would argue that all of these rallies lasted for years, and we're 2 months in. So that argues, in my opinion, for us being in the earlier stages. If emerging markets are doing well, Caterpillar's doing well. I mean, they look exactly the same, you know. My sister doesn't know anything about technical analysis. She could tell you these look exactly the same. So EM's doing well. Caterpillar, although bless her heart, she did come with me to India, and she sat through a 5-hour presentation that I gave, so kudos. So yeah, started at midnight. So she knows a little bit. She's like, that Fibonacci stuff is really interesting. So listen, EM's going to do well. Stocks like Caterpillar, and including Caterpillar, are likely to do very well. So think about those types of global growth, if you will, sort of stocks. To me, China looks like emerging markets. Now remember, this is the Xinhua 25, so these are the US traded stocks in China. Breaking out of downtrend lines, acting very similar to EEM. They look exactly the same. So I like China. I like EEM. I like that whole story. I'm in. I'm sold. We want to be buying them. So this is the communist index, right? So this is the Shanghai composite. So these are not the FXI. You know, I see a failed breakdown below the former lows. I think we're ripping. I think the squeeze is on. Here's a closer look. Look at the lows at the beginning of 2016. We were not able to hold below those. There are a lot of dead bodies here. I think we squeeze. I think we're squeezing. This is all part of the emerging market story, in my opinion. And what was really interesting, in the fourth quarter, stocks are getting killed. Brazil's breaking out to all-time highs. Like, what the hell's going on? Something is going on here. So sure enough, so up at the top, we're looking at an equally weighted emerging markets index. And down below, we're looking at a ratio of Latin America versus emerging markets. So in other words, Latin America relative to the rest of EM. Ripping as stocks are getting slaughtered in the fourth quarter, showing a ton of relative strength. That's evidence of accumulation. Institutions are buying Latin America. Number one, that's really interesting. We should probably be buying Latin America. You know, number two, think about from a risk appetite perspective. If these institutions are buying frickin' Latin America, you know, they're not positioning themselves for a market crash, right? That's evidence of risk appetite, in my opinion. Brazil, man, looks great. Breaking downtrend lines, I think we go retest those highs. I think the squeeze is on. By the way, look at this super tight consolidation in Brazil. So this is the EWZ, so this is the ETF. So look at the super, super tight consolidations. When you see super, super tight consolidations, just churning really, really tight, those resolutions in either direction tend to be very powerful, right? The market has finally resolved, and this resolved higher. So number one, from a trading perspective, that's great. We're in the 40s in EWZ, we gotta be long, right? I think we're going back to 55. That's still a big move. It's 20%, 27%, it's a lot. Latin America looks exactly the same. Brazil obviously is a big component of that. And similar, breaking out. I think Latin America goes to 41. We're above 34, gotta be long ILF, gotta be long Latin America, or Brazil, or Freeport, or something in that world, right? Because listen, if you own ILF, EWZ, Freeport, Macmoran, like, that is not diversification, right? They look very similar. So, pick your poison, but these are the types of stocks we wanna be buying. Vietnam, again, not a safe haven. Vietnam, downtrend, breakout, retest, we're resolving higher. I think we're going to 20 in Vietnam. Taiwan, 25 years of nothing. Nothing. Listen, Taiwan's breaking out of a 25-year base. Think about the semiconductors, right? This isn't natural resource country. This is tech, semis, right? But what's really interesting, and I encourage you, go listen to the podcast that I did with Mark Dow. Go to technicalanalysisradio.com with Mark Dow, and Mark made a great argument that there is a behavioral correlation among emerging markets. So while, like India is tech heavy, Taiwan, right? And then you got others that are more natural resource heavy, of course, like Brazil, for example. From an asset allocation perspective, these money managers don't give a damn. They just get me in emerging markets, just sprinkle it around for everybody, So even though, these economies couldn't be further apart, there's a behavioral correlation among emerging markets, and we see it. But let's still remember that Taiwan has nothing to do with natural resources. Great speakeasies, by the way, in Taiwan. Who knew? Excellent cocktails. Next time you're in Taiwan. $2015 highs, we're back above that. Those 2015 highs, man, go country by country by country. Oh, so important. If we're above those 2015 highs, how can we be shorting stocks? Thailand did nothing for almost 30 years. Nothing. Could we be breaking out? I think, downtrend line, retesting the breakout, off we go. Makes sense to me. Egypt, of course. Here's your former high, there's your breakout, there's your retest. You think they're buying Egypt as a safe haven? Saudi Arabia, 3-year highs. Saudis. Again, risk appetite to me, not risk aversion. Here what I did was I take the top 10 stock markets in the world and equally weighted them. US, India, Japan, London, China, Hong Kong, Germany, Canada, Brazil, and Australia. Top 10 in the world, consolidating sideways, breaking out. Not breaking down. This is the chart we were looking at in 2015, on January 15th, and really showing that the divergence that we had, right? So this is an old chart. The divergence that we had with higher highs in the S&P, lower highs all year in what I call the equally weighted top 40 index. So it's the biggest 40 stock markets in the world equally weighted. And I'm like, man, look at it kind of poking its head above that. Like, call it a wedge or whatever you want to call it. But this consolidation is trying to resolve higher. And if it does, US stocks are probably going to do well, right? That was the thesis. And what happened? We ripped. And US stocks did well. How about that? This is a global marketplace. Stocks in the US weren't up in 2017 because of New York or Trump or DC. Stocks in 2017 were up because stocks all over the world were up, right? We're in a global market. And then here's just a closer look. These are the top 40 stock markets in the world breaking out. Got to be buying stocks. So here's the S&P 500, 2660, that's my level. If we're above 2660, we're not in panic mode, right? We're not aggressively shorting stocks. We're not raising cash. We're buying stocks, showing relative strength and positive momentum. Here we are near a flat 200-day moving average. This is the definition of a hot mess. This is what this is. So if you're wondering what a hot mess looks like, this is it, right there. Flat 200-day moving average, sloppy mess. Momentum's getting oversold and overbought, can't make up its mind. Hot mess. I think we're going higher. Here's the S&P 500 futures breaking all the downtrend lines. Again, within the context of a hot mess, but I think the path of least resistance continues to be higher. Stocks are breaking out from consolidations, not breaking down. We want to be buying those breakouts. NASDAQ near a flat 200-day moving average. These are the futures, but still heading higher. I still think the squeeze is on. 7,000 is the level. If we're above 7,000 in NASDAQ futures, can't be short, right? Add this one to the Japan chart that we looked at before. These are two of the most important indicators I'm watching today. 7,000 on the NASDAQ. Here are the Dow futures, getting awfully close to an all-time high. And what do we know about all-time highs? It is not characteristic of a downtrend. And we're close, very close. So the way I learned it, whenever in doubt, zoom out. We always want to, we get focused, what did the Dow do today? We should have seen all these junkies today in the mountains. What's the Dow doing? What's the Dow doing? I think stocks were up, gold was up, everybody was making money today. Bonds were up, everybody was making money. And we're just jumping off cliffs trying to kill ourselves. So, for you Fibonacci lovers out there, here's your 2000 high, March 2000 high in the Dow. Here's your 2007 high in the Dow. Where did we get to this year where we came tumbling down? A cluster of extensions from both of those peaks. So sure, ignore the rabbit cave thing if you want, but man, has this thing been helpful. Go to allstarcharts.com/Fibonacci. I really just lay it all out there. I'm an open book. So the way I see it, we're consolidating at a perfectly logical level. And we've been consolidating for like 13 months. So we could probably consolidate for several more months, 15. That would be perfectly normal within a monster uptrend. So think about the implications of a breakout in the Dow to new all-time highs above this key level. Not only has it been resistance over the last year, these are important extension levels. What's next? 38,000. I don't think we get there tomorrow. People are like, oh my God, JC thinks the Dow's going at 38,000. I could already see it. The trolls will love that one. What's wrong with 30,000? 3,000 points to the upside, 3,500 points? It's a lot. Stocks are probably doing well in that environment, right? We want to be buying them. Transports. Failed once, failed twice. Third or fourth time's probably a charm. We want to see new all-time highs in the transports with those industrials, and I think we get it, right? For you guys who remember, I was end of the world bearish in the fourth quarter because of this failed breakout. So the thesis was, okay, we don't want to be buying stocks, so we want to either be shorting them or load it up in cash. Either one's acceptable depending on our objectives, right? Number one, how low are we going? And number two, how long is this going to take? Either way, we didn't want to be buying stocks. None of those are environments we want to be buying stocks. So I'm thinking best case scenario, we break out towards the end of the first quarter, early second quarter. I'm thinking that's the best case scenario at the time. That scenario is probably looking pretty likely, So, not a bad scenario. 15-month consolidation after a monster move. Study history seems perfectly normal. Russell 3000. This represents approximately 98% of all investable assets in the U.S. equities market. You can tell I've said that a few times, right? Man, if we're above 165, how are we going to be bearish? Micro caps. These are the little nothings, right? It doesn't get more speculative than the micro caps. Man, looking good, right? Rally, consolidation, breakout, retest, rally. Seems perfectly normal. I think new all-time highs are coming in microcaps. So here are the Dow composites. So these are 65 stocks, 30 in the industrials, 20 in the transports, 15 in the Dow utilities. I think a breakout's coming. Utilities looking good. Interest rates are not looking good. You're getting that sympathy bid. We'll talk about it in a minute. I think we're getting a breakout to all-time highs. The Low Volatility Index, did I say that right? Volatility, low volatility. Scotch, right? New all-time highs. Go and look at the components in this index. ExxonMobil, 3M, I think Home Depot, a lot of big ones. Look at the list. A lot of important names, all-time highs. Got to take that seriously. So here's an interesting one. I take the largest the Dow Industrial Average is a price-weighted index, right? The largest 5 components represent a third of the entire index. Boeing, United Health, 3M, McDonald's, and Home Depot. So I just equally weight those as a good indicator, theoretically, for the rest of the index, and we're breaking out to all-time highs. There's a Dow Fab 5. There's a Dow Jones Industrial Average. As you would think, they look exactly the same. So if the 5 most important stocks in the Dow are creating an all-time high, this one's probably coming next, right? I think so. Here's the NASDAQ 100 equally weighted. You have these idiots talking about how, all of this year's gains are like 5 stocks or something stupid like that. Okay, fine. Well, the equally weighted NASDAQ 100 is less than 2% from an all-time high. And if I didn't do the math today, we're probably even closer. So this is not a narrow rally. This is a broadening rally, broadening participation. We're seeing more sectors going up, more stocks going up, not fewer. So be careful with those misleading headlines. Anything to sell ads, right? I think we might be dead. Giancarlo? Okay, we're good. Here's the equally weighted S&P 500. That's 500 stocks-ish. Breaking out above former resistance. These are the sorts of things we're seeing, right? I'll rip through 5,000 charts. I'm seeing a lot of this stuff, right? New highs, breaking through resistance. I'm seeing a lot of that. And not in a few names. This is equally weighted, man. Lumber futures were a great tell. Monster divergence before the 2015 peak. Great tell. So while stocks were still going up in the summer, lumber was getting destroyed. And I'm emailing my friends like, yo, you see this lumber? Like, yeah, man. It's like, what do you think? It's like, I don't know, I try not to think about it, right? But, and these are the smartest friends I have. And, something's up. Stocks around the world are now making new highs. Emerging markets peaked in January. Financials peaked in January. Lumber's getting slaughtered. It's like, dude, if the S&P and the Dow fail to hold those January highs, shit's gonna hit the fan. And then it did, right? So now lumber is back above those former highs. I think that's constructive. Here's the New York Stock Exchange advanced decline line, stocks only, because remember there's a lot of different issues on the New York Stock Exchange that convert, closed-end funds and stuff like that. So we want to look at stocks only, all-time highs in the advanced decline line. For you guys who don't know, it's advancers minus decliners, right? It's a cumulative average. All-time highs. Here's a great indicator that it's a little late for you guys to use now, but for the future. So I look at the percentage of stocks on the New York Stock Exchange that are above their 200-day simple moving average. And when, stocks are selling off, and it's not like I'm, Monday morning quarterback over here. We were talking about this chart in November and October and December, right? It's not when the percentage falls below 15%. It's when it gets back above it. We want to be buying stocks on their way up, not bottom fishing on the way down. So if and when the market starts getting crushed in the future, this is a great chart, one of my favorites. And once again, it worked, right? I think we got down to like 10 change percent. When we got back above 15, we ripped. Great one for the future. So all right, JC, Trump and China trade and this Powell guy. Can somebody give me an answer? Who's Powell? Who is that? Who is he? Nobody knows? Disney? Disney, okay. I'm supposed to be shorting stocks because of some guy named Powell. I don't know. The way I see it, here's the Global Fund Manager Survey. They have more cash on the books than any time between now and the 2009 lows. So what's the catalyst? I don't know anything about China trade deals. I don't know who this Powell guy is. I don't know anything about interest rates. I see a lot of cash on the sidelines. You want fuel? There's your fuel. Wilshire 5000 has nowhere near 5,000 stocks. Like not even close. Like I think it's like 3,000. I think we retest those highs at the very least and break through it. A very broad measure of the stock market. So for you Dow theorists out there, the Dow got back above the former lows in the first quarter, the industrials that is, and we were wondering, okay, are transports gonna do the same? And they did. So all of these shorts are wrong. Anybody who was long and got stopped out or raised cash, right, is wrong. So think about the psychology. If you were long and are no longer long, you have to get long again. If you got short, you have to cover. In order to cover shorts, you have to buy. Then we notice that, and we're like, ho. So the momentum guys start getting involved, which creates more of a short squeeze, right? I think that's what's happening. We saw it in France, right? The little hook, right? We're seeing a lot of that. Small caps versus large caps ratio absolutely got destroyed. Broke below former support, 2016, 2017. Held below it, and now the squeeze is on. If we're seeing small cap outperformance continue, that suggests to me evidence of risk appetite, not risk aversion. Another great measure of risk appetite versus risk aversion, in my opinion, historically, is the high beta stocks index versus the low volatility stocks index, which is making new all-time highs, if you missed that. To me, the squeeze is on. And if that squeeze is on, notice the divergence, by the way, before. That was part of the evidence to get very short in early October. If the squeeze is on in the high beta versus low volatility index ratio, stocks are probably doing well in that environment. You know, we talk about financials because in America, we don't have bull markets without banks, right? Technology represents 20-something% of the S&P 500. Tech rules the world, blah, blah, blah. Important index. But you go back, the highest R squared of all the sectors, the highest correlation between all the sectors and the S&P 500 is actually industrials. Here are industrials relative to the S&P 500 breaking the downtrend line from early 2018. I think we retest those former highs and break out of a 7-8 year base on a relative basis. I would argue that is extremely constructive for stocks overall. And I think we do get that. Brian mentioned Boeing. Boeing's breaking out to all-time highs. Like the highest ever. You know, those sorts of things, in my opinion, don't happen in an environment the stocks are selling off. I mean, they make freaking airplanes, for God's sakes. So if we're above 363, we want to be long Boeing. I think we go to 570. Aerospace and defense, back up, but look at that failed breakout, the crash, retest. Now we're breaking out. If we're above 205 in the aerospace and defense ITA, got to be buying stocks. Add this chart to the NASDAQ futures and Japanese Nikkei as the important indicators moving forward. You can add aerospace and defense. ITA is the ticker. If we're above 205 in the ITA, it's great for industrials, right? I think it's great for stock market overall. We got to be buying stocks. So we are not, for the record, the trolls out there, we do not want to be aggressively buying stocks with Nikkei below those 2015 highs, NASDAQ futures below 7,000, ITA below 205. That is not the type of environment that we want to be buying stocks. So if you start to see that, we want to be defensive. Oh, how could I just pass over railroads making all-time highs? Speaking of things that don't happen in downtrends, railroad stocks breaking out to all-time highs. And then you go individually. UNP, Union Pacific, new all-time highs. CSX, man, this one's coming. We want to be buying that breakout. If we're above 72 in CSX, we want to be long. I think we go to 92. That's 20 points. It's a lot. Norfolk Southern, I think we go to 203. I think we keep going. Just, railroad by railroad by railroad. Howard's in the back, like, GC, who cares about railroads? You weren't thinking that. He's like, can we look at Google? Nike? The answer is no. 3M, Dow Fab 5, stair step higher. Dow component, momentum's in a bullish range. You can go to allstarcharts.com/momentum and explain how I look at that. Momentum's in a bullish range, successfully retesting 188. I think the squeeze is on. Hard. I think we go to 280. Expeditors, Morgan's favorite client. My fiance's in shipping. So, monster base. What do we learn from Luis Yamada? That's 2 Luis Yamada shout-outs today. The bigger the base, the higher in space. Here's your breakout. We literally kissed the 161.8% extension of that entire consolidation for you Fibonacci haters out there. Failed miserably, which is perfectly normal. We've consolidated, and I think the breakout, 1, 2, 3, man, we want to buy that breakout. If we're above 78 in Expeditors, that's EXPD, not to be confused with EXPE, Expedia, not that. Expeditors, if we're above 78, we want to be long, I think we go to 111. Here's a closer look at that. I think we're going higher. Healthcare, man, healthcare. This is healthcare on a relative basis. Downtrend line for 3 years, we're breaking out. Momentum in a bullish range. I love it. Here's Pfizer. Consolidation, retest of that key extension. If we're above 42 in Pfizer, we want to be long. PFE, I think we're going to 50. Here's probably one of my favorite charts in the world. Has been all year. Medical devices. Healthcare is like, they have many different kinds of companies. You know, you got biotech, you got pharma, managed health, medical devices, they're all totally different. Medical device stocks are tech stocks stuck in a healthcare sector. New lows in medical devices at the end of last year, higher lows on a relative basis, much higher lows. That's evidence of accumulation. In my opinion, we want to be buying leadership groups, not bottom fishing the laggards, like just the crap that nobody wants. Why do you need to be the first one in? We want to be buying things that are already working, right? You know, when the fund manager is on Monday morning and they're like, all right, guys, what do you want to buy? You think they want to buy the stuff that's killing them or the stuff that makes them feel good inside? They're going to be buying the stuff that's working for them. So here's IHI, here's the medical devices. Breaking out, I think we're going to 250. So let's talk about some medical device stocks, right? You hear me talk a lot about indexes and sectors. The way I learned it, if you trade the averages, you get average returns. We want to look at all the indexes, look at all the sectors, but pick the stocks within those sectors. Medtronic, poster child of medical devices. First chart in my chart book. You too, Bruns? Are they? If we're above 86 in Medtronics, we want to be long. I think we're going to 123. Stryker. A little late now. We're making all-time highs, by the way. We want to be, if we're above those highs from last year, we got to be buying Stryker. SYK, I think we go to 226. Here's Smith & Nephew, not Smith & Wesson. Smith & Nephew, SNN. If we're above 38, we want to be long. I think we go to 53. Here's Varian Medical, not a household name. If we're above 130, we got to be long. We're making all-time highs, guys. You know? So the sector's showing relative strength. We're breaking out to all-time highs. We want to be buying the leaders in that space. Varian is one of them. If we're above 130, we want to be long. I think we're going to 192. Massey. If we're above 122, we want to be long. Here we are making all-time highs. I think we go to 186. Materials. Nobody cares about materials. They represent like 2% of the S&P 500. At most, I think. Here's your 2015 highs. We're above those levels. I think we're going to 62, led by chemicals. Nice little failed breakdown. I think the squeeze is on. This reminds me of France. All of these shorts are wrong. Anybody who got stopped out or raised cash on that break is wrong. The only way to unwind being wrong is to buy it back. I think the squeeze is on in chemicals. So in early January, I said, man, if the stock market's going higher, financials are going to be going higher, right? So I called this the 50 and 57 market on January the 14th. And what that means is I look at the regional bank index and I look at the broker-dealers. Regional banks, 50 is the 2007 highs. If we are above the 2007 highs, how can we be bearish stocks? The bearish thesis begins and ends with this being a monster failed breakout and regional banks are getting destroyed. If we are above the 2007 highs, by definition, they are not getting destroyed. In fact, it's the opposite argument. It would argue that we're breaking out of a decade-long base to new all-time highs, and that's the type of environment where we want to be buying stocks. Same thing with the broker-dealers and exchanges. You can add the regional banks and broker-dealers to that list of NASDAQ and Nikkei. If we're above the 2007 highs in regional banks and broker-dealers, we have to be buying stocks. You don't have to be buying bank stocks. Howard's like, thank God. We don't have to be buying bank stocks, but we want to be buying stocks in general if these things are happening. Cincinnati Financial, new all-time highs. Consumer discretionaries retested former resistance from 2017, literally snapped back. Yes, hot mess, path of least resistance is higher. Retailers, great indicator. You know, for you guys in San Francisco who come to the meetups, we said if aerospace and defense can't hold those former highs and we break, that's a heads up something's wrong in the market. This is in September. And the second chart was retailers. If we can't hold the 2015 highs in retailers, something's wrong. Sure enough, we broke in those and the rest of the market ultimately broke. So we want to be watching regionals. We don't just want to ignore it now. Not regionals, retailers. Path of least resistance still higher. A big mess, path of least resistance still higher. Home builders. This was the leadership group to the downside. In a lot of environments where like, oh my God, we need to be shorting stocks, we need to be short. Okay, fine, let's short stocks. But which sector is driving this selling? Who's taking us lower? Right, in 2007, it was home builders and banks and stuff like that already underperforming. A lot of times that people are making a bearish case, we can't identify that sector taking us lower. This time we did. So, add this one to the most important charts in the world, in my opinion. If we are above the 2015 highs in homies, we gotta be long. Gotta be long. Tech, above the March 2000 highs. If we're above the March 2000 highs in tech, how can we not be buying stocks? It's a quarter of the S&P 500. Semis, man, if we're above 1365 in semis, to me, that argues for a historic, structural, multi-decade breakout in semis. Remember what we said about Taiwan? Looking good. All fits in the same story. Oh, JC, it's only a couple of stocks. Well, here's the equally weighted semiconductor index, 2% from an all-time high. I'm seeing expansion in participation, not weakening. NVIDIA. If we're above 152 in NVIDIA, we gotta be long. I think the squeeze is on. Nice bullish momentum divergence. We're seeing a lot of these. You notice? A lot of them. I think that bear trap is in. The hook is in. Shorts are wrong. Anybody not long is wrong. I think the squeeze is on. 152 is the level. Advanced micro. If we're above 21.5, gotta be long. I think we got 10 points of upside. Software, about to make all-time highs. Boom. How can we be shorting stocks? Cloud computing, about to make all-time highs. How can we be shorting stocks? A great indicator is consumer staples. If the long-only community is getting defensive, they're gonna overweight consumer staples, right? So when we had higher highs in the S&P, lower highs in consumer staples, right? Or this is the S&P 500 is the numerator here, so this is upside down. So this is consumer staples putting in a bullish divergence compared to the S&P 500. That was another reason to be getting short stocks in early October. So flip that thesis. If this continues to rally, so this is S&P as the numerator, consumer staples as the denominator. If this continues higher, and I think it, again, how many times have we seen this bear trap, this hook? I think the squeeze is on. And if the squeeze is on, that means consumer staples are underperforming the S&P 500, which is characteristic of an environment that stocks are going up, not down. Now, just because consumer staples are underperforming doesn't mean we don't want to buy them. Here's Procter & Gamble, multi-year base. If we're above 95, got to be long PG. I think we go to 126. Here's a closer look. Nice breakout. Reits have sucked forever. I mean, down, right? So this Reits relative to the S&P 500, hello, maybe poking its head out a little, maybe a little squeeze. What happens if Reits are outperforming the S&P 500? Something interesting there. Here Reits on an absolute basis breaking out of a 4 or 5 year base. Here's a closer look at Reits. I see a big base. I see us trying to break out. Telecom, remember Reits pay high dividends. So does telecom. Squeeze is on. Here's your failed breakout. Retested that former support. The squeeze is on. I think we go to 35 in telecom. Again, higher yielding. Verizon, I like buying this dip. If we're above 53, got to be long Verizon. I think we go to 69.5. Master limited partnerships, also high dividend paying. Killer double bottom, ripping. So let's think about that. Master limited partnerships, telecom, REITs, higher dividend paying stocks, outperforming, doing well. Why? Fixed income investors are not getting their yield in the bond market as interest rates are getting slammed. So you're getting a sympathy bid in the stock market. There's that inter-market analysis that we're doing, that we're seeing information in the bond market and information in the stock market matching up. That's what we like to see. UK, Germany, Japan, all these interest rates are making new lows. Do you think our rates are going higher with rates around the world making new lows? No. If we're below 3%, we got to be buying bonds. So here's the bond market, right? Here's your failed breakout, and interest rates are going down, right? Even today, bonds were up with stocks up. So at the top is regional banks relative to REITs. Market thinks rates are going higher. They're going to be more inclined to buy regional banks. If they think market rates are going lower, they need to be buying higher yielding securities, right? Copper gold ratio also looks exactly like US 10-year yield. If I took off the labels, you wouldn't know which one's which, right? Commodities saying rates are going down. Stocks are saying rates are going down. So what are we going to fight that? The US 5-year yield is to the bond market what Belgium is to European stocks, as far as I'm concerned. Excellent indicator. On that breakout, on the failed breakout, what happens here in fives, I think, is going to tell us a lot about where rates are going. If we start breaking below 245 and are holding back there, got to be long bonds in that environment. And remember, the stock market is suggesting that, right? REITs, telecom, all these things. So if rates are going higher, right, they're pricing in some sort of inflationary forces. All right, well, what's the bond market saying about inflation? Here we're looking at inflation-protected treasury securities relative to traditional treasuries, breaking down, not out. If this was up here, I'd be like, all right, there's inflation stuff. So rates could be going higher in that environment. I would argue this would argue the opposite. This argues towards lower rates, not higher rates. And then, the yield curve, this yield curve, that. Forget that for a second. These are just bonds across the curve. Here's a short end. This to me looks like a downtrend, nice bottom, and a breakout. Here's the benchmark, 7 to 10 year, downtrend, bottom, breakout. Here's the long end, downtrend, bottom, breakout. Do we want to be selling these or buying these? We want to be buying smiley faces, selling frowny faces. These are smiley faces. Here are 30-year futures. Here are 2017 lows, resistance, 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 resistance. Here we're back. If we're above 146 on 30-year futures, we got to be long. For you non-futures traders out there, here's the ETF TLT. If we're above 122, got to be long. I think we go to 130. German Bund, new highs. It's not just a US thing. We're seeing new lows in rates around the world. Makes sense. Crude, I like it. I think we're ready for the next leg higher. We hit the 38.2% retracement of the entire sell-off last year. Sold off, makes perfect sense. Here we are. If we're above 56, got to be long crude. I think we're going to 64. And if you guys don't care about crude oil, if you trade stocks, maybe you should care because they look exactly the same. So if you look throughout history, sometimes oil is negatively correlated with stocks. Sometimes, usually there is no correlation. I don't care who you are, they've been positively correlated for years. So if we are right on this trade and we are long above 56 and this is ripping towards 64, stocks are probably making all-time highs. So if our upside objective is hit in crude oil, I would argue the S&P and Dow are making all-time highs in that environment. So let's come all the way full circle. Higher oil makes sense with a lower dollar. Do we want to be buying this or we want to be selling this? I would argue we want to be selling it. Here's the more traditional US dollar index, hot mess, in the middle of a massive range. The dollar doesn't need to get destroyed, right? But the argument coming into the year was if it was ripping, stocks probably weren't doing well in that environment. So the opposite has been the case. If we start breaking down below 95 in the dollar index, I think stocks are absolutely ripping. Emerging markets are doing great. Shout out Tom Bruni. The title was The Golden Age of Precious Metals. You want to get people in Vancouver excited? You write a title like that. So here's the US dollar index up top, inverted. So if it's going up, dollar's going down. And if it's going down, dollar's going up, right? So we make it look like gold. Because they're inversely correlated, historically, as you can see here. So is it like this, where dollar falls and gold rallies? Or is it like this, where dollar rallies and gold falls, right? So is it like this or like this? Whoop. You know? How many of you raise your hand if you think it's like this, where the dollar sells off and gold rallies? Raise your hand. About a third of the room. And then who thinks that the dollar rallies and gold sells off? Even fewer people. So, variant. I'm going to be betting on this one. Lower dollar, higher gold. Look at Swiss franc. They look exactly like gold. This sucker needs to get going, right? Because it's just dead, right? The only thing worse that you could have bought than gold the last several years is Swiss franc. So here's a really interesting one, guys. I'm almost done. I swear to God, I'm almost done. This is super interesting. So this is an equally weighted basket of the Brics currencies, Brazil, Russia, India, China, and South Africa. And then this is an equally weighted basket of the biggest 6 base metals, copper, aluminum, zinc, lead, tin, and nickel. They look the same, right? This was a really shitty drawn trend line, so sorry about that. My mistake, but you get the idea. Down, right? So with lower lows in base metals at the end of last year, we had higher lows in these Brics currencies. To me, that argues towards strength in Brics currencies, weakening dollar, strong emerging market stocks, right? The same things that I've been saying, right? This is another chart that kind of adds to that. Super interesting chart. So here's gold. You know, there's still trouble around 1380, but I got to tell you, we start getting above 1400, I think we're a straight shot towards 1600. It's a big, big move in the gold market. Here's silver. We talked about it. Here's your long-term downtrend. We can get as high as 19 pretty quickly. Oil reliable, though. You know, gold and silver might suck for years, but palladium, all-time highs, you know? Patrick apparently is long palladium back there. You know, I mean, we're halfway up to our target, so I mean, a little late for you guys following along. You've been long already, congrats. But, you know, the break at above 1200 was really it. I think we're going to 1655. I mean, you want to talk about relative strength in precious metals. GDX breaking down trend lines. The people in Vancouver are flipping out right now. They're loving it. They're like, I told you. Here's Franco-Nevada. I like this one. So this is one of the ones showing relative strength within the gold mining complex. For above 76, we want to be long. Franco-Nevada, I think we go to 86. And for you masochists out there, this is Bitcoin. I mean, this thing is just, what am I going to say? The way I see it, 2,900 to 4,600, that's the range. If we're within that range, there's nothing to talk about. Ethereum, if we're below 136, I don't think there's anything to talk about. I don't think there's much to talk about above 136. You know? I mean, I know there's some crypto junkies around here listening, so I figured I'd, you know, bring it along. This is Chart Summit. You bring charts, right? Litecoin, probably the best of all of them. You know? I guess. You know, we were still stuck below all that support from last year. You know, if we're below 50, it's hard for me to get long. You know, listen, if we're above 50 in Litecoin and you want to take a shot, you know, look for a potential double, all right. The probability is not on your side. But the risk reward is, which is more important in my opinion. So if you're okay taking a small loss, which I am, if we're above 50, all right. All right, so that's all I got. So if you want to copy the slides, info@allstarcharts.com, and the password is Chart Summit. Thank you, guys. If you enjoyed this video, I encourage you to take advantage of our Chart Summit discount offer. For just $649, you get 6 months of All-Star Charts premium research. Normally, this is $1679 for the entire year. but this discount gives you complete access for 6 months for only $649. Please visit allstarcharts.com/chartsummit19 and take full advantage of this discount offer. With your membership, you will receive complete access to my entire chart book, which includes almost 1,000 regularly updated charts, the monthly conference call, weekly newsletters, the trade ideas page, and as always, your membership is risk-free. If for whatever reason you decide this is not for you, just email us within 30 days for a full refund. No questions asked. Visit allstarcharts.com/chartsummit19 and please email me once you join and introduce yourself. That's allstarcharts.com/chartsummit19. Thanks for watching.